TheoTrade. This is Don Kaufman. It's October 17th, 2018, and you are watching the Theo Night video. Well, let's get started, of course, with our levels inside of the S&P futures. Today, the FOMC minutes came out. I got to tell you, by looking at the chart, well, I could not tell you when or where the FOMC minutes came out. In effect, they were meaningless to us today. Nevertheless, everything that matters right now, and I do mean everything, it's about levels inside of the S&P futures. Now, these are levels that I've been going over day in and day out, and the irony of that is, well, we're sitting basically on a level that's 2811. This is what we call our gravity points. Now, I'm going to zoom out once again to a 30-day 1 hour just to give us a little bit of feel for one of these gravity points. And the reason I'm bringing these up once again, as I mentioned, in the midst, of volatility, that we're very likely to do nothing more than ping back and forth, between these levels. Of course, down below over here, and again, these are the S&P futures, that's 2731. Right here, the level defined that we are literally sitting at this moment happens to be none other than, 2811. Just above that, we've got 2842. So obviously, there's approximately 3 levels currently in play right now, though. These levels are determined by a fairly arduous process of me going back and evaluating trade. The levels themselves are about areas of concentric risk, kind of defined by a lot of major trading firms. For the most part, these levels happen to represent where trading firms are roughly neutral in terms of their delta risk, and that gets a little bit ugly to explain over here, but we have plenty of time to do that within the TheoTrade chat room. Nevertheless, these levels, obviously, even if you're not necessarily completely clear on how they're being distinguished, clearly you can see that they're in play right now. So we hit the 2811, and one of the things that I mentioned a moment ago was a market that's still in a highly volatile situation. So you may be asking yourself, though, if, well, hey, Don, come on, after yesterday's rally, are we still in a volatile situation? So before we do anything, again, yesterday's rally, of course, this is Tuesday's rally. We came into Monday's trading session. Monday's trading session has been nothing more than chopping around the 2811, which is exactly what we'd expect, kind of absorbing some of that move that we had from yesterday. Nevertheless, that question still looms, like, are we still heavily into a degree of volatility? And the answer from my perspective is unequivocally yes. And how would I define that? Well, a number of different means. Number one, I want you to cruise down. I want you to look at the VVIX. The VVIX, the volatility of the volatility index, still at an extreme level. A reading in and around 110. Again, a reading in and around 110 is about as extreme as it gets. That means duck and cover. You should be rocking back and forth underneath your trading desk, if you will. Nevertheless, that's only one kind of indication. What might be another indication that we're still in the throes of more of the extreme? Well, that answer might be found in what we term the volatility futures. And again, these are questions, that as a trader, you should be asking yourself from time to time. Don't for a second let this stuff just go and kind of think like, oh, just because somebody says we're in a volatile marketplace, well, we're going to be volatile. Now, check it out for yourself. If you take a look over here at the volatility futures, this is the, again, 35-day volatility futures, and I want you to measure those against the 63-day volatility futures, and let's have a party. You can even go out about 91 days. And what you'll effectively see in the terms of the last price, and I'll kind of script this up here for you, the last price, we still have a slight inversion of volatility futures, which means the risk is heavier 35 days from now than it is 63 days from now. So long as these volatility futures are either flat or what they're looking like right now is very slightly inverted, volatility is absolutely with us. Again, you wouldn't expect to look at like one indication of that. We looked at the volatility futures, we looked at the VVIX. I could go on for 20 different minutes about this. We're still pinging at levels. If we're pinging back and forth between levels, that means the markets themselves are still in a highly correlated state, and we're likely to see Well, just that. We're likely to see more volatility and more movement from level to level. Now, with all this being said, okay, we've forgotten about one of the most important things the last couple of trading sessions. It's been the bonds, okay? Why do we forget about them? Because they haven't done anything. Now, this is incredibly important. Today, the FOMC minutes came out. One of the minutes, all they said was, we're doing what we said we're going to do. I mean, Powell held a conference. What did you expect him to do? You know, in the minutes, there was going to be something very deep in there. They did exactly what they said they were going to do. Okay, they're on track to raise, okay, another time in December. And the dot plot shows, you know, there's the closing bell. The dot plot shows yada, yada, yada. We're going to continue to raise at a gradual pace, you know, into 2019. Listen, the punch bowl is getting moved, you know, out of the way. And the markets are going to feel the pinch of higher interest rates. The market didn't necessarily not like that. It already knew that. Okay. However, we've got to talk about the bonds for a moment. And the reason that I want to talk about the bonds and explore the bonds, okay, first of all, they're about to make another move. I'll come back to that in a minute. The bonds are about to make a move. Okay. All the volatility that we've seen in the S&Ps and all the volatility we've seen in the Nasdaq, what was it sparked by? It was sparked by the ZB getting absolutely clocked day in and day out, right? And as the ZB gets hit, interest rates have shot up. All of a sudden, though, everybody forgets about this. Do you know that the last trading week, what have the bonds done? Nothing. I mean, they've been in an incredibly tight range. Now, it was 3 weeks ago that I told you that the bonds were going to spark wild volatility. And there's the wild volatility. I'm going to say it again. The bonds now, okay, these things are poised to move. The initial movement is to the downside. We're going to get a threat once again of interest rates going higher. Again, I would anticipate over the next couple of trading sessions to see a dip back to the downside in the bonds. However, okay, it does not mean that I'm going to trade bearish inside of the bonds. And I want to make this, okay, without unequivocation. I am watching the bonds, okay, with the belief that they are going to break lower in the days to come. That lower activity, all right, in these bonds has an inverted correlation, of course, to the interest rates. The interest rates are going to go up a little bit. But as these bonds sell off, it's probably going to spark more volatility. From there, all bets are off. They may actually pile back into the bonds and start buying bonds. Bonds could be used as a hedge again. Okay, make no two ways about it. All I'm actually dictating by looking at these bonds is they're poised to move. As they do move, it's going to spark more volatility in the S&Ps. Okay, and we're going to go for another round, of course, of that volatility in the S&Ps, which, again, the bonds, they are priming to make a fairly substantial move. They've had nothing but a docile move in the last week. I mean, I love the look of the bonds right now because these are like, you know, the bonds, they started a fight and then they stood back and actually watched. Well, they're about to get involved again. So be on the lookout. Bonds breaking to the downside, sparking another round of volatility to the S&Ps, which brings me to another couple of points. First of all, the financials. They have a bid under them. This 2650 is pretty much the line in the sand for the financials. The financials are the linchpin in this entire marketplace. Now, the marketplace as a whole today was generally speaking flat, but the financials are up by 1%. What gives over here? Okay, for the markets to continue any downward momentum whatsoever in this market, okay, you're going to need the financials participating. Okay, from where I stand, and I'm going to give you kind of an opinion-based trade. From where I stand, there is still a little bit more upside potential. Again, there's still a bit more upside potential to the S&Ps. The S&Ps have the likelihood of getting bid back to the upside. As they get bid back to the upside, okay, we're going to look to sell out of the money, again, out of the money call spreads in that. The volatility is still relatively high. Now, I'm going to go out. When I say I'm going to be selling call spreads, I'm going to go out, you know, almost 2 months out in time. Now, some people would argue, like, why would you ever want to sell 2 months of premium? Here, you want to see? I'll show you exactly why. Okay, just look at an option spread around, I don't know, here's a 290. It's right around like a 30 delta option, right? There's your delta, okay? And it's just the 290 calls. It's trading for about, let's call it $2.50. Now, the only reason I really selected this option, it's right around a 30 delta, and it's around $2.50. So why would you want to go 65 days out and sell anything? I'm going to have to sweat for 65 days. I don't want to do that. No, you don't. Okay. Let's assume that you're only trying to collect about half the premium in here. See, the reason I like to go further out in time is there's less directional risk incurred. The options further out in time, you might think to yourself, they don't have as much decay associated with them. And of course, you'd be right, but they also don't have the directional risk, which is the amount of gamma. Okay, gamma is actually light in here, not going to have to worry about it. But do these options decay? What I want you to do is think about these 290s, okay, then close it up and just fast forward from the 65-day expiration. Here, let's jump to the 30-day expiration. And let's look at the exact same 290, okay, call. So what? It's a 290 call. Like, no, it's not. It is a 290 call. This one just happens to be in November. So what I'm actually saying is that if you went out and you are to sell, okay, this 290 call, it was trading for $2.50. That was out in December. If you held that, okay, for a whopping, 35 days, that option would decay from $2.50 all the way down to 86 cents. Don't tell me that there's not good rates of decay out into the future, right? And that's one of the things people make a huge mistake. They'd rather sell, let me sell for the next 30 days. Well, you're going to sell for 30 days. The most you can possibly make is 80 some odd cents. And you're going to sweat for that 30 days to make that 87 cents, okay? On a percentage basis, you're going to feel the fear in trading that. So we're going to go a little further out in time. The other thing is you don't have to go out and sell an option naked. Okay, selling option naked eats up a huge amount of margin. It's just not right for everybody. So, we could go out. We could sell like a 290, I don't know, maybe buy like a 295. Listen, it's a $5 wide spread for about $1.37 credit. We can analyze the trade all you want. It's just a short call spread. Okay, what am I trying to make? About half the $1.38. How long will I have to wait? Maybe 30 days, okay, to make about, 55% on this particular trade. But again, don't mince words over here. I still anticipate a little bit more upside, okay, potential in the S&Ps in the next few days. And you can see even in the after hours over here, a few earnings announcements coming out, okay? So look for a bid back to the upside. Now, how far are we going to get, okay? Do I think we can get all the way to 28.42? I do, but I don't think we're necessarily going to see that. Okay, what I would anticipate, and I'm actually going to zoom out here for a second. What I would actually anticipate over the next day or two is specifically a bid just shy of that, and then a harsh intraday sell-off. You're going to have to sell that call spread, okay, in the face of adversity in a marketplace that happens to be rallying. But hey, this is volatility. These are the opportunities that are going to present themselves. You're going to have to get in, okay, and negotiate the fact that, marketplaces can run. Look in the overnight session for 28.11. With that, I want to thank everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.